Right now, something very big is building under the surface of the global economy, and most people are completely unaware of it. While everyone is busy watching stock markets and headlines, a silent force is rising in the background, and that force could trigger one of the biggest financial shifts we have seen in decades. The truth is simple, but dangerous. Governments and central banks are trying everything they can to keep the system stable. They want stock markets to look strong, they want confidence to stay high, and they want people to believe everything is under control. But behind the scenes, the pressure is building. And it's coming from one place: bond yields. Bond yields are not just numbers on a screen. They represent the real cost of money in the system. And right now, those yields are rising, slowly, steadily, and dangerously. This is not just happening in one country. It's happening across major economies: the United States, the United Kingdom, Europe, Japan, all moving in the same direction. At first, it may not seem like a big deal, but once these yields start approaching critical levels, especially around that 5% zone on long-term bonds, everything begins to change. That's the level where pressure turns into panic. That's the level where markets start breaking, because higher yields mean higher borrowing costs. Governments struggle. Companies struggle even more. And suddenly, the entire system that was built on cheap money starts to crack. And here's where it gets even more serious. This isn't just about financial markets. This is happening at the same time as global supply pressures are increasing. Energy markets are unstable. Shipping routes are under stress. Critical materials needed for agriculture, manufacturing, and technology are becoming harder to access. Think about it. If key resources like fuel, fertilizers, and industrial gases get restricted, what happens next? Prices rise, food becomes expensive, production slows down, and inflation doesn't just stay, it accelerates. This creates a perfect storm. On one side, you have rising costs and inflation. On the other side, you have rising bond yields tightening the system. And in the middle, economies are trying to survive. Now here's something even more interesting. While Western economies are reacting quickly, making aggressive moves and trying to control outcomes, other global powers are playing a completely different game. They are not rushing. They are not reacting emotionally. Instead, they are watching, waiting, and positioning themselves quietly. They understand something very important. Time is a strategy. Instead of jumping into conflict or making sudden moves, they are slowly adjusting supply chains, controlling resources, and strengthening their position in key markets. This includes not just industrial materials, but also something very critical: precious metals like silver. And this is where things start to connect. When supply of key materials gets restricted, even slightly, it doesn't take long for markets to feel the pressure. Liquidity starts tightening. Availability becomes an issue, and prices begin to react sharply. We've already seen signs of this happening. Small disruptions have created large reactions. Now imagine what happens if this continues on a larger scale. This is not just a temporary situation. This is a shift. A shift in power, a shift in control, and most importantly, a shift in the financial system itself. Because at the end of the day, when confidence in paper systems starts to weaken, people don't look for promises. They look for real value. And that's where gold and silver come into the picture. This is exactly what we break down here on Gold Silver Scope, helping you understand what's really happening behind the scenes in the simplest way possible. Now let's go deeper into what's really happening, because this is where the real story begins. The global system today is heavily dependent on debt. Governments, corporations, and even entire economies have been running on cheap money for years. Low interest rates allowed borrowing to explode, and that created growth. But it was artificial growth. Now that bond yields are rising, that entire system is under pressure. Think of it like this. When money was cheap, companies could borrow easily, refinance easily, and survive even if they were not very profitable. But now, as yields go higher, refinancing becomes expensive and in many cases, impossible. This creates a dangerous situation where a large number of companies, often called zombie companies, are suddenly at risk of collapse, and it's not a small number. A significant portion of the economy depends on this cheap debt structure. If that breaks, the impact will not be isolated. It will spread across markets, industries, and eventually into everyday life. At the same time, something unusual is happening in financial markets. Normally, when bond yields rise, stock markets fall. That's how the system is supposed to work. But right now, stocks have remained relatively strong despite rising yields. This creates a major imbalance. It means that markets are not behaving naturally. Instead, they are being supported, directly or indirectly, by policies, liquidity, and expectations. But this kind of imbalance cannot last forever. History shows us that whenever markets disconnect from reality, the correction that follows is not small. It is sharp and aggressive. And here's the key point. This is not like past bubbles where excitement and hype were driving prices. This time, the situation is more complex. The system is stretched not because people are overly excited, but because the structure itself is unstable. Now let's bring gold and silver into this picture. As confidence in financial systems weakens, central banks around the world are quietly increasing their gold reserves. They are not doing this randomly, they are preparing. Because gold is not just a commodity, it is a form of money that has no counterparty risk. It does not depend on any government promise. And in times of uncertainty, that becomes extremely valuable. At the same time, silver is playing a dual role. It is both a monetary metal and an industrial metal. It is used in technology, energy systems, and advanced manufacturing. So when supply gets tight, it creates pressure from both sides, investment demand and industrial demand. Now imagine a situation where supply is restricted, demand is rising, and financial systems are under stress. That's when prices don't just move, they explode. And there are already signs that some countries are becoming more protective of their resources. Instead of exporting freely, they are holding back, building reserves, and securing their own future. This includes precious metals, because in a world where currencies can lose value, real assets become power. There is also growing discussion around the idea of future monetary systems being linked, directly or indirectly, to physical assets like gold. Not necessarily a full return to old systems, but a modern version where gold plays a role in settlement between nations. If something like that happens, it would change everything. The current system, which is heavily dependent on the US dollar, could face serious competition. And that would accelerate the shift toward a more balanced, multipolar financial world. And in that kind of environment, holding real assets becomes not just an option, but a necessity. Now, let's talk about where all of this is heading, because this is the part most people are not prepared for. If bond yields continue rising and cross critical levels, the pressure on the system will become too strong to manage. Stock markets, which have been holding up so far, will eventually start to break. And when that happens, it won't be a slow decline. It will be fast, aggressive, and widespread. Because once confidence starts to drop, it spreads quickly. Investors rush to exit, liquidity dries up, and markets that once looked strong suddenly collapse under their own weight. At that point, central banks will have only one option left. They will step in, and they will print money at a scale we have never seen before. This is what is known as quantitative easing, but on a much larger level. The goal will be simple: to rescue the system, support markets, and prevent total collapse. But there is a cost. When you create more money, the value of that money decreases. purchasing power drops, prices rise, and everyday life becomes more expensive. This is how currency devaluation happens. And during this phase, something very important takes place. People lose trust in paper systems, and they move toward real assets. Gold and silver become safe havens. Not because of hype, but because they hold value when everything else is losing it. At the same time, supply constraints, industrial demand, and global tensions can push silver into a much tighter position than most people expect. This creates the potential for massive price movements. Now think about the full picture. Rising bond yields, breaking financial markets, massive money printing, currency devaluation, and increasing demand for real assets. All of these factors are aligning at the same time. This is not a normal cycle. This is a reset. And those who understand it early will be in a completely different position compared to those who ignore it. That's why it's important to stay informed, stay aware, and understand what's really happening behind the scenes. If you want simple, clear, and powerful insights on gold and silver, make sure you stay connected with Gold Silver Chart Scope, because this is where we break down complex global shifts into easy, actionable understanding.